Imagine that you're walking into a grocery store with a $100 bill in your pocket. Last year, you could fill your cart to the brim, but this year, the same $100 barely covers half of what it used to. Sounds familiar? This is the impact of inflation. Now imagine the opposite scenario where prices are dropping and your money suddenly seems to go further. That's deflation. Hey champs, welcome to the MoneyMind Quest. I am Jimmy. In this video, we discuss the critical concepts of inflation and deflation, how they impact the economy and your personal finance. If you're all about upgrading your personal finance, then you want to join the MoneyMind Quest champs by simply smashing the subscribe button. And at the end of this video, be sure to take the financial literacy test to help you improve personal finance skills. All right, let's dive right in. Understanding inflation and deflation is key to making informed financial decisions. Inflation. Let's start with inflation. Inflation is the rate at which the general level of prices for goods and services rises, and subsequently, the purchasing power of currency is falling. Central banks, like the Federal Reserve in the United States, aim for a moderate inflation rate, typically around 2% per year. A small amount of inflation is considered normal and even beneficial, as it encourages spending and investment, driving economic growth. However, when inflation rises too quickly, it can erode the value of your money. Imagine you have savings in a bank account earning 1% interest annually, but inflation is running at 3%. Essentially, you're losing 2% of your money's purchasing power every year. Deflation. Now, let's flip the coin and look at deflation. Deflation is the decrease in the general price level of goods and services. While this might sound good because prices are falling, it can be a sign of economic trouble. Deflation often leads to reduced consumer spending, as people hold off on purchases expecting prices to fall further. This can lead to decreased business revenues, layoffs, and an overall slowdown in economic activity. When prices are falling, companies earn less revenue. To cope, they might cut wages or lay off workers, leading to higher unemployment rates. With less income, people spend even less, perpetuating a vicious cycle that can be challenging to break out of. This is known as a deflationary spiral. So how do these economic phenomena impact your personal finances? Inflation impact. Let's start with inflation. One of the most immediate effects of inflation is the decrease in purchasing power. Your money doesn't go as far as it used to. This makes budgeting more challenging, especially if your income isn't increasing at the same rate as inflation. Inflation also affects interest rates. Typically, central banks raise interest rates to control high inflation. Higher interest rates mean that loans and mortgages become more expensive. On the flip side, savers might get a better return on their savings, but only if the interest rates on savings accounts outpace inflation, which is often not the case. Investments can also be impacted by inflation. Stocks might be a good hedge against inflation because companies can often pass on higher costs to consumers. However, bonds can suffer because their fixed interest payments lose value in an inflationary environment. Inflation affects an economy in advanced ways by distorting consumer and business spending. It could affect exchange rates, impacting international trade by making exports more expensive and imports cheaper. Additionally, it can redistribute wealth as savers lose value on their savings while debtors benefit from repaying loans with devalued currency. Deflation impact. Now let's consider deflation. With deflation, your money increases in value, which might sound great initially. However, falling prices can lead to lower wages and higher unemployment. If you're in debt, deflation can make your debt more expensive in real terms because while the amount you owe remains the same, your income might decrease, making it harder to pay off. Savings, on the other hand, might benefit from deflation as the purchasing power of your saved money increases. But if deflation leads to economic recession, your job security could be at risk, which might negate the benefits of increased purchasing power. Here are things to know and avoid when dealing with inflation and deflation. Monitor economic indicators. Keep an eye on inflation rates and central bank policies. This will help you anticipate changes in interest rates and adjust your financial plans accordingly. Diversify your investments. In times of inflation, diversifying into assets like stocks, real estate, or commodities can help protect your portfolio. For deflation, consider more liquid assets that retain their value. Depending on your country, some examples could be treasury bills, short-term government securities. 2. Money market funds, investment funds in short-term, high-quality investments. 3. Certificates of deposit CDs, short-term CDs with fixed interest rates. 4. Precious metals, like gold and silver in easily sellable forms. 5. Short-term government bonds, bonds with short maturities from a stable government. And adjust your budget. Regularly review and adjust your budget to reflect the changing costs of goods and services. Look for areas where you can cut back if necessary. Don't forget to take the financial literacy test at the end of this video. Manage debt wisely. Be cautious with taking on new debt, especially in uncertain economic times. If you have existing debt, prioritize paying it down to reduce the burden if deflation hits. To build an emergency fund. An emergency fund can help you navigate economic uncertainty, providing a cushion if you face job loss or unexpected expenses. Now let's talk about some proactive steps you can take to plan against the impacts of inflation and deflation. Invest in inflation. Protected securities consider investments like Treasury inflation protected securities tips, which are designed to protect against inflation. Their principal value increases with inflation, providing a buffer. Real estate investments. Real estate can be a good hedge against inflation, as property values and rental income tend to rise with inflation. However, ensure you're prepared for potential volatility in the real estate market. Additionally, consider the location and type of property, focusing on areas with strong economic growth and demand, ensuring that the investment remains valuable and in demand over the long term. Stay liquid in deflation. In deflationary periods, maintaining liquidity is crucial. Having cash on hand can help you take advantage of lower prices and provide security if economic conditions worsen. Staying liquid during inflation helps by providing flexibility and reducing risk. Liquid assets can be quickly converted to cash, allowing you to take advantage of opportunities or address financial needs as they arise. Review long-term financial goals. Regularly review and adjust your long-term financial goals to reflect the current economic environment. Whether it's retirement planning, saving for a home, or other investments, staying flexible and informed is key. Remember, both inflation and deflation have their unique challenges. By understanding their impact and planning accordingly, you can safeguard your finances and make informed decisions. Financial education is not just a one-time learning experience, it's a continuous journey that benefits everyone, whether you're just starting to manage your finances or have been doing it for years. Newcomers to personal finance can greatly benefit from understanding the basics, such as budgeting, saving, and investing. Meanwhile, those who have been managing their finances for a while should stay updated on new trends, strategies, and economic changes. At both levels, you need to be aware of how economic factors like inflation and deflation can impact your financial health. Staying informed and continually educating yourself helps you make better decisions, avoid common pitfalls, and take advantage of opportunities that arise. Remember, the journey to financial freedom starts with building a solid foundation by learning. So don't forget to join the MoneyMind Quest champs by simply hitting the subscribe button. Using this information, take the financial literacy test in the description below and identify the areas where you need improvement. Share this video and check out this one. See you next time.